Before we dive into our session, we just want to kind of bring you into an awareness of the values that Tribe Network holds in terms of our organization. So you can see them on this slide here: lead with love, nurture community, demonstrate and practice inclusive leadership, and be creative in your ways of operating with one another and in your business. So just to guide us and ground us in those values before we start the session. And another housekeeping note is just, if you want to keep your camera on or off, it's up to you, whatever feels comfortable. Please show up however makes the most sense to you. We know that there's a lot of, caretaking and other priorities in the evenings in the Atlantic Canadian side, which is where we're all at, aside from our facilitator tonight. So feel free to show up however you would like. Before we get into the session with Marlon, it'd be great to hear some of your voices and just know what's going on with you and your business. So if you feel comfortable, just 3 people can unmute themselves one at a time and introduce their name and give us a little elevator pitch on what's going on. I know most of you, and so if I have to call in someone, I will, but I'll leave space now for you to engage.
Hi, good afternoon, everybody. Can you hear my voice?
Hey, Dahlia. Yes, we can.
Oh, perfect. So I represent Angel Card Electronics Plus, and we're a tech company, and we're in the Maritimes, also in Ontario as well, in BC. And I just want to say hello to everybody. This is my first meeting today, so I'm live. Hi, everybody.
Nice to have you here, Dahlia. Thanks for making time.
Thanks.
Anyone else? Clinton, I'd love to call on you. I see you might be unmuted. I'm not sure if that was to chime in or if you're with us. Oh, Bernadette, is that one of your grandbabies? You're muted. We want to hear from both of you.
My one and only surprised me last night from LA.
Oh, nice.
And I have to go away for 2 weeks.
Oh, nice.
But she's staying for a month, so I'll get to see her when I come back.
She's beautiful.
Yeah, say hi, Amora. Say hi to the people. Hi.
Hey, Amora.
Hi, these are all Nanny's friends.
Oh, she's sweet.
It's
good to have an assistant, a cute assistant.
Yeah, gotta be on Nanny's lap, yeah.
Nice. Okay, we'll get one more person to introduce themselves. Unless Bernadette, you want that to be you. I know you got your hands full.
I always leave it to everybody, the newcomers, people. You need to really take this opportunity to talk about yourself and your business. This is where you get your exposure. You talk about, you never know who might be using or looking for your services. So I always try to wait, but you know what? We want to get on with the session. So if nobody wants to step up, I will say something, but I'd like to see somebody else come in. You know what? I think Miss Donika Willis needs to introduce herself.
Donika.
I had a feeling you were going to say what? I'm definitely okay with introducing myself. I run a creative studio that basically, specializes in crafting, branding, graphic, and web design solutions, specifically that are accessible, inclusive, and kind of have a real focus on storytelling and how businesses can really, really kind of capitalize on sharing their authentic story through visuals. Yeah, that's my elevator pitch. dwcreative.com.
EW or DW?
DW, like Arthur DW.
Okay, great. I love that. Okay, can you put your links in the chat?
I will, definitely.
Wonderful. I'm really excited to hear about your services. And thank you for taking the invitation from Bernadette to introduce yourself. It's definitely a great opportunity. So now we're going to dive into this session, and I just want to introduce Marlon from Future Capital. So he's an individual whose organization is bridging equity in the venture capital space. He began his organization only recently in August 2020, and the organization aims to give underrepresented people paths to get involved in startup investing. He's an angel investor, a startup founder in his own right, and spent a number of years creating pathways to success for underrepresented leaders in the startup space. He's also worked with Hootsuite and Lululemon on the board with Lululemon, I believe. And he's an instructional designer by trade. I listened to a couple podcasts to get these details. Also, Marlon, I love it. He has a background in program development also, which he supported Hootsuite in. He believes that learning is the best mechanism for upward mobility and prosperity, and he's joining us from Western Canada. One other piece about Marlon is that he loves seeing the potential in other people, and that's his leadership mission. And so I really appreciate that in him. I had an opportunity to work with him in the foundations program that he ran, and I really hope that from the session tonight, you get a sense of who Marlon is and the resources that he has, and engage with him further. And so without any further ado, I would love to hand it over to Marlon to take us into this evening's content.
Thank you for that introduction. And you probably saw me laughing. I was like, where did she get this information? I didn't write that down anywhere. I appreciate the diligence that you did, and that's all accurate. And I so appreciate the intro. And I also want to say to the tribe, the team at Tribe, thank you for bringing me into this experience. I'm excited to be here. And I think the one thing that you said about me that stood out the most is just like a passion for helping others in their work, and so as a result, I'm really keen to learn more and engage a little bit more with the group that's here today, be that through the chat, through questions, as I move through some of the materials that I've set up for the day. But I think where I wanted to start is just by doing a little bit of a deeper dive into my background, and then kind of just dive right into the materials. So I think I just lost am I still with you guys?
Yep, you are. Yeah, we can hear and see you.
Okay. I lost my my place though. My Zoom screen. You must have made me a host or something? Is that what happened?
Yeah, I stopped sharing, but I'll reshare.
Oh, that's what happened. Okay.
I'll reshare it again. Yeah.
No, you're all good. You're all good. I found you. I found you.
Okay.
I spend a lot of my time in Zoom, so I usually don't get turned around. I just got a little surprised by that. But yeah, I'm super excited to spend some time with you all. I think I will need to share my screen in a couple minutes, but before I do that, I'll just tell you a little bit about how I'm approaching today's session. So when we build out training, we typically work on the investor side, and part of the reason is in my background, I worked with a lot of startup founders, a lot of creatives, did a few of my own consulting gigs and side hustles, but I found the most powerful unlock for me in my career was really understanding how investors make decisions, because there's a lot of power in being literate and early stage investing, in particular in venture capital, especially if you're building a business or working with early stage companies. For example, I heard one of the participants runs an agency and is a content creator, and even from that angle, understanding the needs of a startup and how they get funded can be incredibly powerful. So that's the lens that we typically come at it from. And what I want to do today is just kind of walk through a couple pieces of the puzzle as it relates to funding a startup. We're going to bounce around a little bit, but I really want to have as much of a conversation as possible. So I'm always really, really curious to hear what's coming up on the other end of these conversations. I'm also very comfortable just talking at you for an hour and a half, if that's what you prefer, but it's always a little bit more fun if I get to hear and see what's happening on the other end. So that's my request, is that you speak up, share, ask questions, engage with the material to the best of your ability, and I'll make sure to take your time to pause as we move through the presentation here to create space for that. So maybe before I dive in, does anybody have any like specific items, specific outcomes that they're looking for from today's session? Is anybody, specifically looking to understand, a concept, some terminology? Is there a problem in anyone's business that they're looking to, solve over the course of the next hour and a half? And I'll just create a little bit of space for that question, and curious to hear what's coming up on it.
How do we get money so that it comes in every year? So like to get someone, how do we get money so that every year we don't have to, you know how some people have different outlets,
Yeah.
and they provide finances to them every year?
Yeah.
How do we get to that stage? So
How do
we're
you
not-
get recurring revenue?
Yeah.
Or recur? Yeah. Okay, that's a really good question. Unfortunately, that's a really challenging thing to make happen, but I will address that, and I'm glad to hear the question. And I'll touch on that right away, actually, because I can give you a couple anecdotes. I'm a startup founder. Future Capital is a startup. We're 3 years in. I've also worked on the venture capital side. I see I'm digging into my intro already, but and so I've worked with literally hundreds, if I actually counted, it might be thousands of startups over the past 10 years. And I think the biggest, most consistent challenge for every startup is capital. And it's resourcing the business. It's burning through capital faster than they thought they would. And then those challenges get obviously, amplified or, multiplied when you're looking at underrepresented founders or individuals from underrepresented groups. So I think the actual best answer to that question is it's going to be really challenging to get recurring capital that isn't revenue. So if you have like some sort of a subscription model or some sort of a model built into your business where the customer is paying on a cycle, that is the best way to get recurring capital into your business. But beyond that, I think the way to create as much financial sustainability as you possibly can as a business owner is to diversify your streams of capital. So it's looking for, capital from startup investors, angel investors. It's looking for grant funding. It's looking at driving revenue, looking at like paid partnerships, right? Like diversification creates sustainability because you're not relying on one source, one partner, one revenue stream to run your business. So that's my short answer. We'll dive a little bit deeper, but I'm really happy to hear the question. I see another question in the chat. Do you have any specific? Oh no, that was a question, someone repeating my question. Yeah, I'll make some more space and see if anyone else has anything specific that they want to chat about before I take it away.
So
here.
do you have, sorry for bothering you.
No, it's all good, please.
Do
That's what
you
I'm here for.
have a sheet or some information where all these streams are so that it makes it easier for myself and some of these folks on here to have that access?
Yeah, that's a good question. I don't have anything prepared in terms of like all of the different streams, but I will point you to a couple really strong resources that you can use. One of them is actually on our website. We've got a glossary essentially for terms that you should know, and within that glossary there's I think it's like 50 terms you should know before investing into startups, but for founders it really breaks down the key terms, including revenue sources, and I'll make sure to get you some additional resources on different capital streams as well. Yeah,
Thank you, appreciate it.
no problem. Last call. Anyone else want to jump in and share any burning questions, anything they're looking to get uncovered specifically today? Okay, well, with that, I'm going to take, I see someone's hands up. Samuel, yeah, please.
Yeah, no, I guess one thing that's on my mind is how do we present ourselves to investors in the most, like both the most attractive way, but that's still authentic, and not really inflating the value of what we can provide. Just, it's like,
yeah,
still very grounded and real about what we have, but just how to refine our pitch almost.
Well, inflate it,
Yeah.
because that's what everybody else does. So we have to play that same game.
Yeah,
Right?
inflated.
You can't be too humble.
Okay.
You got to tell investors the best version of the story and share your vision in the best light that you possibly can. There's
Okay.
so much that I could say on this topic, but we will come to that in about 25 minutes. So yeah, we're gonna get there for sure. It's a really good question.
Awesome. Thank you.
Yeah. Okay. So yeah, I mean, this topic is really near and dear to my heart, I have to tell you. I obviously started like an entire organization to evolve the general understanding of early stage investing. But before we dive in, like I said, I want to just share a little bit more about my background. I appreciate the healthy introduction and the deep dive that you did, Lily, into my background, and just to contextualize it a little bit further, and especially for anyone that I haven't met, I think I actually recognize a couple names on the list here, but I'm the founder and CEO of Future Capital, as Lily mentioned, and my current gig is really centered around developing investment acumen and creating more access to startup investment opportunities for underrepresented investors. Before I started Future Capital, I spent some time working at a Toronto-based venture capital firm. And prior to that, I cut my teeth working with a series of well-funded e-com and apparel startups. So I went from like working inside the business operationally to working kind of on what I call the ecosystem side. So venture capital, working in accelerators. So I've kind of seen how ventures are built from pretty much every single different lens that you could, from the inside, from the funder side, and also from the accelerator side, in terms of actually, building and supporting startups at scale. And over the past 10 years, it's actually been, as of next month, it'll be 10 years for me working in this industry. Since I took my first startup job, I've recognized that there's just this really clear and present need for more perspectives in the early stage investment industry. And the reason I say it that way is because, this industry needs you as much as you need it. We need those different perspectives. We need builders and founders and product managers who are thinking about companies and products and services differently. There's massive missed opportunity in the companies that don't get funded and the companies that don't get to build what they, build their vision. So the industry has challenges, and that challenge is I think disadvantaging everybody in the industry. It's not just a problem for us, it's a problem for everybody. And so there's a significant amount of knowledge that one person can gain around early stage investing. I've spent, really the past decade, like I said, accruing some of that knowledge. I think some of the biggest questions that people come to me with are like, how do founders raise money? How do investors make decisions? How does the math work? We probably won't get into that last one today because that's a whole course in and of itself. But I always think it's really important to just get back to basics. So I want to zoom out a little bit and just ask like this really big question. I would actually love to hear what folks in the room have as an answer to this question. What is startup investing? What does it mean to invest into a startup? But I want to kind of zoom out, and feel free to chime in and share. There's no real wrong answer. I'm curious to hear your perspectives or your experience with startup investing and what it actually means to you. So I'll pause there for a second.
I would just start off by saying it's backing what you believe in. And that's kind of a foundational element to the process, from my perspective, at least, is backing the companies and people that you believe in.
Yep. That's very values driven, 100%. Even if you try to make it about numbers or outcomes or returns, at some point, like when you actually look at the landscape, there are too many options or opportunities for it to not be driven by some value at some point in time. So yeah, really, really good point. Anyone else want to share? And don't be shy. There really is no wrong answer. I'm just really curious to hear perspectives before I share my version of the answer.
Hello,
Yes, hello.
can you hear me? My name is Taryn.
Hi, Taryn. Yes, I can hear you.
Could you, I'm sorry, repeat the question again? My computer is a bit
No worries.
swanky. Yeah.
No worries. The question is, what is startup investing?
Okay, so not necessarily what someone's motivation might be.
No, just what is it? Yeah. What's the concept of investing in startups?
Okay, well, thank you. I don't really have a.
You don't have an answer. You just want to clarify. No worries.
What do I think it is? I think
Yeah.
that it is, if I had to put it on a test and get a point for it, what would I put down? I would put, I think that startup investment has to do with putting some money and or some kind of time or something into a project to invite business. It's sort of a marriage of business and money, you know what I mean? And finding a way to sell what it is, or to get what it is you want to sell, I guess.
It's absolutely a marriage. I love that the use of that language. It's a partnership is usually what we, the way we describe it. And I'm glad that you brought up money, because that's what it is. It's putting capital into an organization. I'll just break it down for you here, and I appreciate those answers. And contextualizing it first, I think it's really important to understand that startup investing is a relatively new and alternative asset class. So it's not like real estate, it's not like bonds or the stock market where you've got, decades of experience and infrastructure and, systems and ways, like modes of doing this. This has really only been around, venture capital as an industry, for about 30 or 40 years. And so it's new. And the reason that matters is because it means that there's a general, the general knowledge and sophistication around venture capital and startup investing is relatively low compared to other asset classes, which is an invite to, folks that feel like they are imposters or maybe don't understand how it works. It's an invite to you to come in and shape how it's done, because people are really still figuring this out across the board. And that's like a really, really important piece of context. But in the most simplistic, version of, how to answer this question, it's investing for equity. So it's putting money into a company and getting a piece of the pie, getting a piece of ownership in return. And the term startup really just refers to doing that at the earliest stage of a company's life. So that is really what startup investing is. It's getting involved, putting capital behind your values and what you want to see, built within the economy, and getting a piece of ownership as a result. And the reason it's important for, business owners and operators to understand what startup investing is because you want to understand when and if startup investing is right for your business. And we're gonna get into, how to think about that in a moment. But I'm curious to hear if there are any questions or additions to, my definition of startup investing, anything to add or any clarification before I move forward. So I like to break this down into the simplest, most kind of structured way possible. And so there are really a ton of different ways to refer to the common stages that startups experience. And so that's a bit of a disclaimer. I'm going to spend probably about 5-10 minutes just walking through what it means for a startup to get funded at different stages and who gets involved in those rounds of financing. There's going to be a lot of terminology that I'm throwing in your direction. And unfortunately, there's a lot of different ways to refer to everything that I'm talking about. But what I've tried to do with this, the next 5-10 minutes is just use the most commonly used language to refer to the different stages of early stage funding and financing, and also who gets involved. And I would love to have a bit of a conversation about this as well as we go. And so I think putting the life cycle of a startup into its full context requires an understanding of what the term startup actually means, right? So I just said, we're talking about the earliest stage of a company's life. And what that really refers to on average is the first 7 to 10 years of a business's life cycle. So you can see here in yellow the different stages of financing that most startups go through. And I'll just go ahead and walk through each of those stages. So on the far left, you've got the pre-seed stage. After that, you get a seed stage, Series A, Series B, Series C. And that series, those series of later stage financing you can go kind of further into the alphabet, depending on how much financing the company needs. So I'll give you one example of a company that I think we probably all know, Slack. They I believe raised into Series H, so they went pretty far into the alphabet. Maybe they might have even went further, but that was the last that I checked. So what these represent is really kind of the company drawing a line in the sand and saying, we're raising capital and this is what stage our business is at. And so you can see right below those rounds of financing, the stage of the company. And this is like fairly broad, but I'll just walk through those as well. So when you're at the pre-seed stage, typically you're pre-startup. So you've got a business, right? You might have an idea, you might have a prototype, an early version of a product, but you're typically pre-launch, pre-product, and you're kind of getting this thing off the ground. At the seed stage, you're typically at the stage where you're launching and validating your idea. So you might have a product that you're actually putting into market. You might, get your website up and running. You might start a wait list. You might be generating some revenue at that stage, but you're still incredibly early in the broader scheme of things. And when you get into these series of financing, so Series A, Series B, Series C, and so on and so forth, you're going from scaling. So typically you have something that works, right? You've got a product, you've got a customer, you've got the distribution channels, aka you know how to get that product to your customer. And you're trying to just essentially take that and amplify it, get into new markets, find new customers, go deeper into the markets that are working for you. And as you get into those even later stages, those later series of financing, you're looking at just pure growth and becoming, a mature small to medium enterprise. So that is really the startup life cycle. What I'll point to as well is just on the other side of that yellow line on the right-hand side is what happens when a startup kind of exits startup mode. Typically, it either goes public, so you'll see a startup, have an IPO, initial public offering, or they get sold, and someone else buys or merges with the organization. But that's typically the life cycle of a startup, kind of those different financing stages as we see them. And I'm going to pause here and see if there are any questions about the way we laid this out, or just the content of what we're actually talking about here, the different financing stages. Is there? Yeah, I'm curious to hear if there are any questions or if there's anything that requires some clarification in terms of what I've gone through so far.
Sorry, can you hear me?
Yeah.
I have a quick question just in terms of, is the assumption that the startup cycle particularly only applies to a business that is incorporated, or is it the same thing for like a sole proprietorship, for example?
It's a really good question. Really, really good question. And this refers to corporations. So if you're incorporated, these options are going to be available to you. As a sole proprietor, getting investment into your company works a little bit different. I'm curious, are you a sole proprietor?
I am.
You are? Yeah. And
Mhm.
I'm just out of curiosity, what's the nature of your business?
It's basically just like a creative studio / agency. So I
Oh,
do
yes.
anything from brand identity to graphic design. I've worked on like donor wall installs. That's so like anything visual essentially.
Yeah.
Yeah.
Yeah. Okay. Um, yeah, I think for sole proprietors, the concept of like raising capital needs to be considered from a different lens, because you're not necessarily just like the legal structure of a sole proprietor is quite different from that of an incorporated business. Corporations are, legally structured and set up to take on outside capital, to then distribute that capital, to, small, medium, large teams of employees, and also, break down ownership in a specific way, right? Like you can essentially go ahead and get 100 shareholders to support that company, and so that exchange of capital, that's really kind of what it's set up to do. Sole proprietorships, I'm not a lawyer, but I don't believe that it's as straightforward or as simple to do to actually sell shares in your company as a sole proprietor. So yeah, that's what we're referring to here as incorporated businesses.
Okay, thank you. So ideally, like to follow what you're talking about, the
Yeah.
would be that you would incorporate and then you would be able to take advantage of the stuff you're saying.
Totally. And I think the beauty of like one of my favorite things just about business in general is that you can, like, all options are typically available to you, right? Like if you want, you specifically, sorry, I forgot your name, Donica, is that right?
Yep, Donica.
Danica, if you decided like tomorrow, you know what, I want to scale this thing, I think there's potential, I've got this roadmap, I've got a plan, you could incorporate your business. So it would probably cost you $2,500 and take you about a week to do it, and then use that structure to scale. But yeah, as a sole proprietor, I don't want to say this for certain, because again, I'm not a lawyer, but I actually don't think you can take outside investment as a sole proprietor. But regardless, like corporations, that's what they're designed to do. That is the whole structure is there to do exactly that.
Okay, thank you.
No problem. So I'm going to complicate this just a little bit further and add kind of who's who in the zoo on top. And so when we're talking about, these different rounds of financing and the different stages of the business that are associated with those rounds, I always like to talk a little bit about who gets involved and who potential funders are for businesses at these stages. And so at the pre-seed stage, that earliest stage, historically, it's been friends and family that fund and financially support these businesses. At this stage, kind of in the world of venture, you're seeing a lot more angel investors kind of shift earlier and earlier. And I'd say at this stage, you're seeing quite a bit of angel investing happening at the pre-seed. So really, really early investments, really high risk investments, frankly, but really early investments into companies. And that's just so that folks can become competitive, essentially. And as you move into that kind of seed and Series A stage, you're going to see angel investors, you're going to see syndicates. So if you haven't heard of a syndicate, it's simply just a mechanism for multiple angel investors to invest into one company. So it's a pooled investment vehicle. So you're going to see essentially high net worth individuals like that. That's essentially who this bracket is speaking to, who understand a space or understand early stage companies, or maybe they just have capital. Those are the folks that typically fuel and invest into pre-seed and seed stage businesses. And then as you get into these later stages of financing, you're going to see venture funds, so VCs, and then even as you get into even later stages, you're going to see private equity funds. So that's those are more mature, I'd say by and large more experienced capital allocators that are going to be involved with the companies long term. So as you go kind of from the beginning to the end of a life cycle of a startup, you're looking at these different players. You're looking at friends and family, you're looking at angel investors, pooled angel investors, and then venture capital, and then eventually private equity funds. I think what's also equally important is who's not included in this list. So you typically are not going to see other companies investing into your company. That doesn't happen. One thing that is not mentioned here, but is incredibly important all the way through, it just depends on the type of business in terms of when it actually starts, is revenue. I always remind founders that is actually the best, least expensive version of financing. And what I mean when I say that is every dollar that you give away to one of these groups of people, you actually pay for that in equity. So they own a piece of your business if they get to invest. And so when you use revenue and sales to drive your growth, you're actually you continue to own more of your business when you fund your business that way. So these are the players and kind of who's who in the zoo. And again, I'll pause just to see if there are any questions about who gets involved in early stage funding cycles.
I'm interested.
Yeah.
Hi, this is
Go ahead.
Karima.
Hi, Karima.
I'm interested in the nature of angel investors. What would you say is their benefit? Because you want something, I guess, mutually beneficial.
Yeah.
What drives angel investors to invest, and what can you do as a startup to be more attractive to that?
Big questions. And I'm stopping my screen share because I'm going to move to another slide and just walk you through it. But the high level answer there, and I think this is important. I see some really good points being shared in the chat, and I want to acknowledge those. I think just historically, getting access to this type of capital has been really hard for us, and it still is, and it's important to acknowledge that. And I think to tie that to the question that was just asked, I think the reality of fundraising is that it's a financial exercise, and so for angel investors, their motivation, and I think some angel investors like brand themselves differently and have tell really strong stories, but let me be really clear about the fact that their motivation is to get a return on their investment. The end. That's what they want. That's what angel investors are looking for. They're looking for you to make more money out of what they're putting into your company. And I think frankly, like I'll share personally that I learned this the hard way. Like I started a mission-driven business. I definitely have worked in this space with very closely with mission-driven founders, and every single time at the end of the day, being successful as a founder or as a business owner really comes down to, can I make money for the people that are investing into my company? And that is just a reality of how this goes. So that's the motivation for early stage investors, is to get a return. And then I'd say like that's the chief motivation. And then underneath that motivation, there's always going to be, a range of things that matter to different investors. And that's where it gets kind of interesting and fun, is finding out, okay, beyond just the return on investment, which is why people are investing into your company, what else matters to them? And that's where kind of the relationship building and the I'd say like double-sided diligence process that happens in an angel deal, or as you're going through the process of fundraising, that's where you're essentially going through and gathering that information and understanding. There's really no blanket there's no blanket answer. People are different. Angel investors are people, so they're all going to have different motivations. And part of the act of fundraising is understanding that. It's almost like a sales process, right? Like when you run a sales process, part of what you're doing is understanding what's important to this client, right? Like, okay, we got this product, yes, and typically there's going to be, you know, a competitor. There are lots of ways to solve any problem, right? And so when you're running a sales process, typically you're finding out, how do we make this work for you? How do we understand this individual, you know, corporation or client or person or customer? How do you understand their needs specifically? Exact same thing is true with angel investors. And I'll provide a little bit of a visual here as well. So actually, before I do that, I just want to go back and just underline that this is, you know, in the first kind of 7 to 10 years of a startup's life cycle. And you know, that's really important, because a lot of the businesses that we know of and are familiar with, and the big brands that we, you know, maybe have been following or are really interested are well beyond this point and operate on, honestly, like fairly different principles. Everything that I'm talking about here is talking about like venture building something from scratch in that really early stage of the life cycle of a company. And to, you know, deepen kind of that understanding of, you know, the motivations for startup investors, I think it's really important to understand the way that value is created. It's incredibly important for investors, but it's also important for founders to understand whether or not this is the pathway that you want to go down. And I always like to empower just business owners in general. Like, you do have a choice. You don't necessarily need to go down the path of raising capital. I've done it. It is hard. It's really hard. Even if you know the right people, you know, have a grasp on, you know, what it is that you want to build. And frankly, like within this room, I'm really comfortable saying I think it's additionally challenging for people of color. There's a lot of, frankly, there's a lot of trauma that happens in the process of fundraising, and I'm not going to sugarcoat that. And you just have to make the decision of whether or not you're willing to endure that. It's not all trauma. Like, I don't want to create the wrong impression. It can actually be really rewarding, and being successful can just be, yeah, completely life-changing if you're successful in the process. But ultimately what you're doing is creating value for these shareholders, right? So if you think of, like I said, those first 7 to 10 years, like if you're looking at this kind of curve here, right? Those first 7 to 10 years of a high growth business's life cycle as that startup phase, that is really the phase where the value is built and where the venture is really kind of coming together. The idea, really simply put, is to earn equity by investing early. So that is a motivation for investors to get in early enough that they have like the best valuation, aka the best price on their investment, but not so early that, you know, they don't know whether or not the company is going to exist in 3 months, right? So they're kind of doing a dance of, okay, has this company, this team proved something out? Do I have faith that they're going to build something of value? And essentially, usually what that comes down to is, do I trust the team? Do I have faith in the team? Do I think they have what it takes? And if so, you know, it might be the right time for me to get involved. So the idea is to earn that equity early and enjoy a reward later in the company's life cycle, as the value of the business increases. So really what you're doing is driving that share price up and up and up. And the way that happens is just growth in your business. So I'll just use like a really simple example. I'm not sure if anybody knows the company Smart Sweets. It's a healthy candy company. They're Vancouver based. I know that story really well because Tara Bosch, the founder, went through an accelerator program that I ran. And so when they started their business, their sales were super low. They had one channel of distribution, valuation was $1 million, and they got a bunch of people to invest. And as they kind of moved through this process, they went from a valuation of $1 million to 60 million to 80 million, and then eventually sold the company for $380 million. And so that share price just continued to go up. And that is literally like straightforward, exactly why investors invest, is because at this point, you know, the value of the company is, call it $1 million, and then it's like 36x over here, and then they get out. And that's as simple as I can make it. So and then again, like as I noted here on the slide, a venture deal is like I said, an exchange of value between operators and investors. Thank you for sharing that, Lily. Yes, you are on it. Any questions about how startup investors make money?
I have a question. Well, first, thank you so much for your time and the information.
No problem. Yeah, of course.
Okay, like you mentioned, like the example you gave, they end up selling the company for around $300 million, right?
360.
$360 million. Why did they do that?
Great question. Great question. That becomes a decision. I'd say that it's as much a decision around, you know, what the founder and the team wants to do from kind of like a personal perspective. You have to understand, when you're building a company, the individual that's kind of steering that ship is the most valuable resource. So you are the most valuable resource if you're the business owner. And so for a lot of folks, they get to a certain point and they either burn out, or they want to do something different, or they're you know, done with the grind of building a startup, and that can be a motivator to sell. And then the other piece of it is it was a really good price, and it was a really good exit, and it was a really good opportunity, financial opportunity for them. When they talk, that company specifically, Smart Suites, when they talk about the end of that journey, they talk about the transaction. It's like this really, you know, this line in the sand, this transaction that happens that changes everyone's life. Like literally, I know, like I had a chance to invest in this company and I didn't invest in it, and I'll always kick myself for that. But I know someone that invested 25K into that company and got a 7-figure return in 4 years, right? So that is why they sell, is because there's, you know, a really good opportunity, and there are other factors that are typically centered around like the actual team and whether or not they want to continue to build.
Oh, thank you so much.
Yeah, no problem. It's a good question. Okay, I'm going to move forward and just talk a little bit about how investors support founders, and just break it down into 2 categories. So financial and non-financial. And so financially, investors provide early stage capital, money in, equity out, right? And that early stage capital comes when, frankly, no one else is going to put money into the business. So you can't get a loan from, like, banks will not look at you. Even customers might think that your company is too early when you're raising from investors. Yeah, private equity firms, even venture capital firms have a bit of a limit in terms of how early they'll get involved. So angel investors in particular, and those early stage investors, can put capital into your business before anyone else will. So essentially they're like just taking on the risk that a lot of other institutional investors won't take on. They can also be lead generators for startup founders by connecting them to other investors or folks that are interested in the company. So another, like, this is financial because it's essentially opening doors to new capital. Investors should play a role in that if they have the capacity to do that. And then last but not least, investors can also provide follow-on investments for select companies out of their portfolio. So if I invest $10,000 in a company and I really like the kind of trajectory of that company, I've built a good relationship with the team, 2 years later, I might invest, you know, another $20,000, right? Like there's always the opportunity to add capital to your original investment. On the other side, the non-financial side, investors can provide strategic advice and coaching, but that should always be based on their unique experience and expertise. And I would underline that because I think every investor thinks that they can coach founders, and frankly, not many investors can or should. I think in a lot of cases, investors are just capital, and that's totally fine. That is the core functionality, is to help me fund this business. But in some cases, investors are also operators, or they're like domain experts, or they've got some sort of piece of expertise or experience that they can use to help you as an individual. So that strategic advice and coaching can be valuable. But I would definitely encourage everyone on the call to really assess that before you spend time getting coaching from investors. And then I think the process of raising capital really helps to professionalize the company's practices. So it really forces you to build out a financial model, build out these, key documents that outline, the strategy, the roadmap, go to market. Like, it really helps you to think differently about or think in a way about your business that you might not naturally do if you were just kind of heads down building a company on your own. And then investors can and should also be champions for the brand and the product. So they should be your biggest supporters and cheerleaders once they've actually backed the company. And I think, the last and probably most important thing that an investor can do is trusting a founder's instincts. The person that's leading the business is the subject matter expert. They're always going to be. And so I think really, really good investors understand that and listen and support founders in what they want to do, and trust them to be the expert in their own business. Okay, so what I'm going to do is just pause for a second. Sorry, 1 second here. I'm going to pause and see if there are any kind of general questions. What I want to spend the next half an hour doing is just talking a little bit about investment readiness. I know there were some questions at the top about how to get your business ready, or how to know, or what investors are looking for kind of more specifically. So I want to go there next, but I want to kind of check in and see if there are any questions kind of more broadly about how startups get funded, who's who in the zoo, who these players are, how they make decisions. Yeah, anything about anything that I've covered so far that's
Okay.
lingering before I move forward. Yeah, go ahead.
So if we are a not-for-profit organization, and
Yeah.
most of our money all goes back into the community, because we support marginalized individuals, so on and so forth. And we do events where we give things back to the community, essentials, things like that. And we don't have monies coming in for other reasons. So that might be a strike against us. So I'm suspecting, because we are not for profit, should we be looking at other avenues to maybe down the road have some other kind of income streams coming in, like selling some things or something like that? I'm just saying.
Yeah, no, I love this question. I spent 3 years working in non-for-profit, and we called ourselves a non-for-profit startup, because we were trying to grow really quickly and build a rocket ship with the non-profit model. And I think there were a lot of challenges, I'll be honest, but it's not impossible. So I think when you're building under the kind of structure of a nonprofit, you do just have some legal restrictions in terms of how you can accept capital and money, and then there are also, I'd say, specific opportunities that are available to you because you're a nonprofit. So there are pros and cons. I think, really simply put, the nonprofit fundraising cycle is a longer cycle. As a for-profit corporation that's building a product or a service, you could actually go out there and raise $1 million in 3 or 4 weeks. It's doable. It's not easy, and I'd say it's not likely, but that is something that people can do. As a nonprofit, you can't do that. Like there are just these longer cycles. You're typically working with larger institutions. So you're either working with like foundations, the government, or big corporations who you know, sponsor and donate into nonprofits. I'm probably telling you stuff you already know, but I just say the fundraising journey is a completely different life cycle. It takes a lot longer to get to sustainability. But you do get the privilege of not necessarily needing to provide a return for your investors, for your supporters. And so you get to really focus on impact. You get to focus on the things that are important to you as a leader. Whereas I think the thing that people don't necessarily recognize about for-profit businesses, especially corporations, is that you have a fiduciary responsibility. So you are legally responsible to make as much money as you possibly can for your shareholders. That is how capitalism works. So for better or for worse, like you as a for-profit, your goal is always, you know, increase shareholder value. As a nonprofit, that's not necessarily your goal. So I would say like that's how I would think about it. No, you don't have access to these types of funding sources. Venture capitalists won't invest into nonprofits. Angel investors won't invest into nonprofits. But then you don't have to work with those people, and you get to do your thing and build what you want. It's just going to take more time. That would be kind of my perspective on that.
Thank you.
Was that helpful? Any other questions, thoughts, considerations before I dive into what makes a company fundable? Okay, so I'm gonna switch gears here a little bit. I think we've got what, 27 minutes left? Yes.
Yep.
Lily, I'm gonna check in with you. Are you good if I just go right up until the end? Yeah.
Absolutely. Yeah.
Okay. So what I want to talk about here for the next few minutes is just the anatomy of an early stage company, and again, always looking at this from the lens of an investor, but that is the most relevant lens as a founder or a business owner, because you're understanding what folks are looking for. So what I'm going to do is just talk you through excuse me, the 5 pillars of venture assessment as we see them. And I'm going to share my screen in a moment so you can get a visual. Just bear with me, my computer's being a little clunky here. Okay. All right, so you should see my screen. I've got a second screen here, and for some reason it's really taking its time. Okay. Let me know if you can see my screen now.
Yeah, we can see it
Thumbs
now.
up. Okay, good. Okay, so I'm just going to contextualize this a little bit here for you all. So when we train investors, we train them on the like end-to-end process of an individual deal. And I like to put venture assessment into that context. So I'm not going to go through the investment process that's laid out on this slide. At a high level, what we're talking about is getting from the point of sourcing investment opportunities all the way through to cutting a check. But what is really important to understand is where and when an investor is actually making an assessment on your business. And so that happens typically, you know, as soon as they hear about your company. So if they've seen you at like a demo day or like a presentation, or maybe they saw a press release, or maybe another investor said, hey, I'm looking at this company. What do you think? That's when the assessment for an investor actually begins. That's when they begin calculating whether or not this is a good opportunity for them. It goes into that first meeting, which is an incredibly important engagement, that first meeting between a founder and an investor, and then goes into the actual valuation. So when you actually get to the point of defining a price of the investment, and there's, I think this is really meant to just show that there's a lot of stuff that happens before venture assessment and a lot of stuff that happens after venture assessment. But what's happening when an investor is assessing your company is they're essentially forming a perspective on whether or not they think what you're building is where they want to put their capital, where they want to park their capital, and where they kind of want to make their bet, for lack of a better definition. And so just powering forward, I want to talk about these 5 pillars. When we talk about venture assessment, we talk about these kind of 5 core pieces of a puzzle that a company needs to successfully essentially articulate and demonstrate for investors to understand what the business is and why it's backable. So I will just contextualize again, like where these pillars come from. To do this, we really use a VC lens, so venture capitalist lens, to assess the potential of a startup. And the reason we do that is because even though you have, friends and family, angel investors that get involved at the early stages of venture building, they're all essentially getting a company ready to be invested into by venture capital firms. If without the venture capital firm who come in at that kind of like seed Series A stage with more significant investment dollars, the company doesn't actually go get where it needs to be to provide an exit. So the VC standard is, fortunately or unfortunately, what we need to use to measure startup potential. And I'm just going to walk through each of these pillars and speak to what investors are looking for and what they need to understand to qualify an opportunity. And I think before I do that, I'll just talk a little bit about, more broadly what investors are looking for. So at a really high level, VCs and other professional investors are looking for something that's, I'd actually say, is fairly simple, but it becomes really complicated when you start building all the documents and building the investor decks and building the financial models. But really what investors are looking for are founders and owners who are building something. So that something can be a tool, it can be a platform, a product, a service, a marketplace, but they're looking for something that does 2 core things. So they're looking for someone that's building something that generates some sort of value. So generating that value could mean saving time, saving money, increasing productivity, making people happier, making people wealthier. So something that's generative, creates some sort of value, and also captures a meaningful portion of that value. So all great companies must do both of those things. And I'll give you an example of a really bad version of a company going out to raise capital, okay? So a company that goes out and says, I'm going to give $5 bills to every user. That's my business model, right? That company is going to be really popular. They're going to generate like tons of value. People would absolutely love that company, but it wouldn't stay in business very long because they're not actually capturing any of that value that they're generating, right? It just gives away money, right? And so I think that's like an overly simplified version of something that a lot of companies actually end up doing, which is creating value and not extracting value. So you really have to have that business model in place from the beginning and some sort of a vision so that investors can see, okay, you're creating this thing, you're producing this value, you're putting this thing into the world, be it a product, a service, whatever it is. And over time, this is how you're going to make money. Those are the things that investors need to see, really, really simply put. But on a more granular level, you can actually break it down into 5 pillars, which is what we've done. So I'm just going to start from left and go all the way to the right, and then we'll have a bit of a discussion, but please feel free to jump in with questions. I've lost my chat bar, so Lily, feel free to just call me out if anyone's dropping anything in the chat as I go. But starting with the problem, you've probably, if you've ever like heard anyone talk about startups or heard a TED talk about like technology, you've probably heard someone say this sentence: every startup starts with a problem. Like, I think I've heard that like thousands of times. And the reason that people say it all the time is because it's really true. And it's a really good way of thinking about, you know, how and why to start a business. So when you're thinking about the problem that a business is solving, evaluating the validity of that problem, like understanding whether or not that's like the right problem to be solving, is really about evaluating the size of the problem. It's evaluating the timing. Is it the right time to solve this problem? And essentially the opportunity that the problem presents. So how that shows up is, you know, the market size, right? Like, are there enough customers out there? And this is a really, really important question for business owners to understand. And I think it actually can be the thing that determines whether or not you are going to build, you know, a venture that needs, you know, outside capital, or if you're going to stay in the sole proprietorship, or if you're going to do a nonprofit. It's like, how many customers are actually out there? How big is this problem? Is it something that everybody faces? Is there, you know, 20% of the population that need a solution to this, and we can capture like 2% of that 20%? You have to really get an understanding of like, how big is that problem? What's the opportunity there? And is it real? Like, are people really experiencing this problem? And I like to give examples for this. So I'll give the example of Airbnb. I think they're really good. Like, it's a really simple, you know, parallel to help you understand like what a problem looks like at the very beginning. So the concept for Airbnb originally began because the founders experienced this acute shortage of hotel rooms at a conference that they were staying at in San Francisco. And so there was this lack of equilibrium between supply and demand, right? There was all these customers with all this money that actually needed a place to stay, and that problem was actually the thing that launched this now global business, right? So what the job of those founders was at the very beginning was assessing, is this just a frustration? Is this an inconvenience? Or is this an actual problem that people will pay to solve, right? And their solution was, or their conclusion was, yeah, this is a big problem. Let's build a platform to solve it. And we'll get into the solution in a second. But that problem of, okay, there's a shortage. There's this like a supply and demand issue. There's a customer that we can clearly identify. And there's actually also, you know, essentially like short-term rental spaces in people's homes that are just like totally unaccessed, right? So that problem was big enough for them to build an entire brand, an entire business off of, and scale it like globally. I don't know actually the valuation right now of Airbnb, but it's massive. Like, it's one of the biggest tech success stories in history. And so from the problem, you get to the solution. And I think the solution is really simply put, it's what is being proposed to address a problem. It's not necessarily like, what is the product today? Because building a venture is a process, and it's a very iterative process. So there are going to be different iterations and different versions of a solution. You can look at literally any startup, any tech company, and look in their history, and you can see, you know, a very different version of what they are today that existed 5-10 years ago. But it's what am I proposing? What do I believe is the solution to this problem? And so in the framework that I mentioned earlier, what this relates to is whether or not the company is generating something of value, right? So it's not capturing the value yet, but it's, are we creating something that people actually need, that they will actually use, a good product that actually effectively solves a problem? And I'll use Airbnb as an example again. When they, you know, stumbled upon this problem, the way people were typically solving it was through classifieds. right? So they were going to like the back of the newspaper or like using Craigslist or other online platforms to find places to stay, which is totally insecure. It's not secure. It's not safe. There's no payment solution there. It creates this really broken process for both ends, for the supplier and the customer. And so their solution, Airbnb's solution, was to build an all-encompassing platform where you could do the whole transaction, right? You could do the discovery, the searching, the hosting. You could interface between the host and the guest on the platform, and probably most importantly, you could actually do the transaction on the platform. So you could pay for your stay right there on Airbnb's platform. That solution was, obviously a big part of what they were actually taking to market and what they were taking to investors and what people were backing. And what you're doing as, a business owner, when you're actually talking to investors or even just considering whether or not, your company is ready to take on investment, is really assessing, is the product that I'm building different enough from everything else that's on the market to get some traction? Do I have a roadmap? Do I have a sense of, okay, this is where we're at today. Today we've got, call it like back of a napkin version of the product. In 3 months, we're going to build a prototype. In 6 months, we're going to launch. In 12 months, we're gonna get to this point of revenue. What's your plan? And I think that is a really, really important piece of the puzzle, and that will really, really inform whether or not your company is investable. And then what's the price? Like what's your positioning in the market? How are you actually positioning yourself amongst competitors from a pricing perspective to, again, develop traction and gain momentum in your business? And then when you go back to that framework, when it comes down to like extracting value, that's where the business model comes in. So for early stage companies, business model is less about profit and EBITDA than it is about what is the potential. What is this thing viable, and is it scalable? Is there a realistic go-to-market? Is there a realistic path towards developing traction, gaining new customers? And can that pathway be scaled far enough that the investors that get involved early on get some sort of return on their investment? So, excuse me, I think a good example for business model, I'm gonna leave the Airbnb example alone for a second and talk about Uber. So Uber is an example of a business that in its early stages, and actually even still to this day, is a really, really scalable company, right? Like you can take that company anywhere that there's cars, essentially, right? It's fairly scalable, but to this day, it still struggles with profitability. It's an expensive business to run. It's a complicated business to run. There are tons of regulatory issues, and all of those obstacles make it really, really hard for that company. I actually still believe to this day Uber is not profitable. And that's like really, really important for entrepreneurs and business owners to understand, is at what point does my business become a moneymaker? And if that point is never, then maybe it is a nonprofit. Like maybe it's a different, legal structure that you're entertaining. But again, going back to the motivation for investors, if you're going to go out and raise capital from investors, you have to produce some sort of return on investment. Otherwise, you're entering into like a very imbalanced partnership there. So really what you're looking for when it comes to startups and understanding the business model is there a revenue model that could work for this thing? Do we have enough money in the bank to keep the business running? And on that roadmap that we talked about, what are the big milestones? Like what are we working towards, and contextualizing your business in terms of, where you're at and where you're going is a really, really good way to think of, how to actually sell the business model to investors. And then the next pillar here is strategic fit. And I think this is probably the easiest, most straightforward pillar, because it's essentially just making sure that you're talking to the right investors. So you're talking to folks that can have the capacity to invest into your business. So let's say you want to go out and raise $1 million and you want to set your minimum and check size at 25K. You're probably going to want to talk to investors that are comfortable with that check size, that are really experienced in investing at startups at that stage, versus, at like the earliest stage of venture building, you might be looking for like $10,000, $15,000, $20,000 total, right? Just to get the thing off the ground. And that could come from friends and family. So when you're looking at strategic fit, you're just looking at, am I talking to the right investor for my business at this time? And some of the factors that you want to consider are, like I said, check size, funding stage, the founder makeup. So I think for a lot of underrepresented founders, we have an audience. There are folks there are funds, there are in this program, for example, that are specifically designed to support underrepresented groups. And you kind of want to use those as filters to make sure you're talking to the right people. And the last, and I would say most important pillar of venture assessment and investment readiness is the team. So for investors, what you're looking for, especially in the, I call it pre-seed, seed stage or earlier, is a person or people, so founder or co-founders, who you believe are going to do what's required to take this thing to where it needs to get this thing as far as it can go. In those early stages, you typically don't have, a ton of history. You don't have like 5 years of, tax receipts. You don't have a track record, really. You don't have a ton of stories of customer loyalty. You don't have a ton of transactions. You have vision. That's what you're actually taking out to market. And so for investors, they're really investing in you at those early stages. They're not investing into a product or a really sophisticated model. They're really investing into a person that they believe can do what's required to turn something into a success. So I'd say those 5 pillars are really, really good mechanisms and really good filters for startup founders and business owners and operators to really think through, to understand whether or not their business is ready for, the process of venture financing. Do you have a big problem? Do you have a solution, aka a product that's going to get you some traction and going to reach a large group of people? Do you have a business model that's scalable, that can also make money over time? Do you have an investor that's right for you? And are you and the team that you're surrounding yourself with the right people to be building this thing? All right, I apologize for speaking directly at you for 20 minutes straight, but I'm going to pause. I think we got a couple of minutes left here, and I'll pause to see if there are any questions or comments. I'm always interested to hear different perspectives on how to know if your venture or if your business is investment ready.
Well, I'll open up for some conversation just to get people started. Yeah. Marlon, thank you so much.
My pleasure.
Yeah, I'm a bookkeeper, so but I think I want to be a venture capitalist now. How much schooling and training do I need, or can I just take one of your mentorship programs?
Okay, let me tell you a secret. nobody in venture capital knows what they're doing. I'm not
So I'll
kidding.
fit right in. Okay, I
I'm
get
not
you.
kidding. So there's really no training. That's like part of one of the things I learned over the past few years is that unlike bookkeepers or accountants or other financial professionals, venture capitalists are all very different. They all come at it with like very, very different experience. And there's really no prerequisite. You just have to be able to like get access to the capital. I think that's like the biggest thing is really access to capital. But yes, you are like very welcome to try it out. I think it's a really, really fruitful kind of industry in terms of just getting to really understand business at a different level. But I actually think bookkeepers understand business really well as well. So yeah, that's my 2 cents.
I'm thinking it's almost a compliment because I must say what
For
I
sure.
do is that you're always, because you're a bookkeeper, because you're a small business owner, which I have been for the last 25 plus years,
Yeah.
you're always looking for money.
Yeah,
And when you find
exactly.
it, the person that I am, I try to share it with others. So I think I'm a venture capitalist in my own way because I try to find the grants. And in my day job, we actually are going to be hiring some grant writers to help people write grants because that's our biggest challenge, especially as
I write
Black people,
grants.
is that we don't know where the money is. I was in Toronto for a week and a half, and I spent time with Ryan McKnight at ACBN.
Oh,
I was
nice.
at the Canadian Black Chamber of Commerce. I was at the Black Business Professional
Cool.
Association, talking to Sean DeFreet, is a big wig CPA up in Toronto, right? Because Toronto does everything so big. Like we are still so small p, I say small p politics, small p business here in Nova Scotia. And we only think about what's in Nova Scotia. We don't expand to what's out there. So going to Toronto was like, the digital Nova Scotia, the digital money is okay in New Brunswick and Ontario, but they don't touch Nova Scotia. So it's like, okay, build your business in Ontario, get the money from them and do things. So you have to be really creative when it comes to finding money, how to use it and how to leverage it. I mean, the FACE Coalition, BNI, VOF, there's so many organizations that have money, but to access that money, you need to have the knowledge and to know where it's at, when the deadlines are. And that's a full-time job for somebody, for many people.
I agree.
But sharing that information is so important, which is, I'm glad that you shared some of the stuff today. We're going to get some of your list because we can't stop researching and trying to find out where that money is because there is a lot of money to help and support us, but writing the proposals and stuff is still
It's hard.
a big challenge. So thank you for everything you shared tonight. We could do a whole 40-hour,
Totally.
this is what LSA classes, it's like a 40-hour session, 10 weeks, how to access money, be a venture capitalist. I'm just blown away with your knowledge. So thank you so much for sharing with us.
Can I ask a question?
You can when I'm done.
Oh, I thought you were finished. Sorry.
Give me my time, girl.
You lowered your voice. Thought you were finished. Sorry, go ahead.
You're on, Miss Tarandella. Go for it, sweetheart.
I really thought you were finished. You thanked him and fed him ice cream and everything. I thought y'all were finished. Okay. So thank you as well. And hi, Bernadette.
Hi, Taryn.
One of the things that I wanted to ask you, I guess, was as a Black man, as a person of color, and, in terms particularly with some of our babies or just generally all of us and some of those trepidations we might have. But I'm just wondering if there's some kind of sharing you can do as well in terms of either things to look out for or things, for us to remember specifically as Blacks or people of color going in for some of that funding, if there's a particular avenue that you have found sort of suits you better, you know what I mean? Or cautions or something like that, right? Particularly if you meet up with like a 30-year-old Black man who says, I'm done, that's it, it's over, nobody will give me, what kind of way would you say to him, no, let me tell you, baby, you can go back in and maybe keep such and such in mind, right?
Well, I do really appreciate that question, and I'm a no filter kind of person, so I might not give you the answer that you want, but I think doing this comes at a great personal cost.
Yeah, absolutely.
I think it is really challenging to separate the no's and the rejection from like who you are as a person and your own kind of like validation of your work and kind of your approach and your personality, and like it's really hard not to question yourself in the process. The advice that I would give, this is how I'll answer the question. The advice that I would give myself 5 years ago, before I got into venture capital, before I got into starting my own business, is you need to know more than everybody in the room. Knowledge is power. So you can create like the best brand, the best product, tell the best
Right.
story, build a network. You really need to know how your business works in numbers. You need to understand what people are looking for and take that knowledge and use that as your kind of key to open doors. Because I think unfortunately for us, the moment we seem like we don't understand a certain concept, or the moment that people identify that we're learning on the job, it creates like a really big blocker in terms of getting folks to participate financially in our businesses, right? There's already all these like social and cultural obstacles, but you have to really be like an expert. And so I would say your time is best spent absorbing and gaining knowledge, and then applying it to what you're doing specifically.
Thank you.
Yeah, no problem.
I really love that question. One of my favorite activists and organizers says hope is a discipline, and I really think you have that discipline, Marlon, and I appreciate your perspective. I had a question. There are different categories of individuals who can invest, or syndicates and groups that can invest in your business. When is it time for a founder to take on an advisor instead of looking for capital as a mode of gaining knowledge and access to resources?
That is such an important question. I think you cannot get advisors early enough. My first advisors I started working with before I incorporated, and they I would say convinced me to become a founder. I was very hesitant. I was really not interested in doing this. And they were the ones, my core advisors were the ones that said, no, we'll help you. We're not just gonna advise you, we'll actually help you with the business model and to figure these things out. And so, yeah, I'd say day one or sooner, honestly. And I think the key to selecting strong advisors, unfortunately, especially in Canada, I think a lot of people put their hand up to be advisors, but really what they are is cheerleaders, which we need, and champions, which we need. But the key to selecting the right advisor is someone that's done what you're trying to do. Have they done it before? If they haven't done it, I just would not necessarily take their advice. I would definitely let them be a champion. But if someone has, and let me be specific, I worked with an advisor who had not just started a successful tech company, but they had at the time raised $5 million in capital. So I knew that they could see around many corners, right, for me, and they could actually tell me, these are the documents that you need. This is what you don't need to think about for the first year, right? Have they actually done it before, or been around someone that's done it? And do they have the specific answers to your questions that? So along with never being too early, you also want to make sure that you're selecting powerful advisors that can really, really help to guide you in the right direction and answer your questions.
I really appreciate that. And maybe to add some nuance to it, at what point, how do you determine an advisor who's an equity-based advisor that gets some value
such a hard
from
question.
your company, right? How do you is it a mentor, normally, or is it an advisor, that kind of thing?
Okay, I'm going to answer this question as though I'm talking to my friends first, and then I'll give you the professional answer. What I would say to my friends is okay, so get as much free advice as you can. Basically, is what I would say to my just because you feel so grateful that someone's spending time on you. The reason that I say that is because a lot of folks get this type of advice around the dinner table, right, from their parents or from their uncle or from some, and we don't have that generational wealth of knowledge. We don't have that generational capital wealth. So yes, you can pay for advice, and yes, you can pay for mentorship with equity, but don't do that too freely, because that is your equity. It's like your business that you're divvying up and handing out to other people. And frankly, we're at a disadvantage because most of us, I can't say universally, but most of us don't have, members around the dinner table who can tell us how to do this stuff. So we don't inherit what a lot of our peers inherit. So I think be really, really smart and conservative about giving out equity. But I think where I've given, just to give you a more concrete answer, where I've given out equity in my own business is when someone is essentially providing a service, right? There are advisors that it's like, okay, like, listen, I'm going to tell you the problems that I have and you're going to help like coach me through it. And then there are advisors, I'll give you one example. I have someone that does like PR and communications that did that for us in the early days. And essentially like he was executing on a contract that we weren't paying for, right? Or another example would be, the person that built our website. Our very first website, like 1.0, we're on 3.0 now, but like that's where that exchange is so measurable. And it's like $5,000, right, is what it would have cost. So I will like calculate that in equity. So I think that's when you can like really easily like measure the value of what they're doing for you. Like that's when I would definitely start to entertain the conversation of exchanging equity.
I really appreciate that. I know there are at least a couple individuals in this room who are in a stage of raising, but I won't necessarily call on them. But I hope, if they feel so inclined, that they'll definitely reach out to you. And yeah, I would love to hear from them, but also understand that I don't want to put anyone on the spot.
I did see I'm thinking I'm pronouncing this right, Dahlia's comment, and I just want to acknowledge that is like a reality for a lot of us. Just pure like no's. Everyone says no when you're going out to fundraise. I just want to add like a little bit of insight there. I don't know, what stage you're at. I'm gonna guess you're at the beginning, and I think that is where we need the most support. Is we need like people to replace that friends and family round, because that frankly is really high risk for investors, and there are a lot of unknowns, and it's not a stable investment. Like that's just the truth about it. But as an ecosystem, that is the biggest problem that we need to solve for Black people and underrepresented founders in particular, is that earliest stage of funding.
Dahlia, would you feel comfortable giving a little bit of context around your business to help us understand what it is that you're working on? I'm sorry, I don't know if we've met before.
Hi there. Sorry, I know I've been silent in the meeting. I'm just taking down a lot of notes. It's really good information. I wish I had it maybe back in 2020. It would have been certainly helpful, but at this time, so any sort of funding, like I mentioned, I provide it. So just hearing that there is a way to maybe petition what our operation, like our goals are going forward, to maybe some partners and stuff like that, like some of the things you mentioned would be really helpful for us. We have had some positive feedback, and now we're having companies contact us and wanting to partner with us. Nice. But we do need help with mentoring, with automation of our operations, just several areas. So just being a part of the group and seeing that the resources are available, I'll be definitely taking part in that.
Appreciate that.
And we are, just to let you know as well, sorry, I didn't mean to stop there. As I mentioned before, we are in Ontario. So that's where we try to get a lot of our funding, and especially to support our activities in the Maritimes and out west in BC, but was not successful. But it doesn't mean that we'll, stop trying to acquire financing, but it's been difficult. It has been really
Yeah.
difficult. Yeah.
I've seen it so many times, and I've even experienced it myself. Like, knowing what I know, it was, even like for us, fundraising was really challenging. And I think, yeah, honestly, I think it's really important to talk about these things and your experience specifically, so that others can learn, and so that we can kind of share some of this knowledge. But I think that, I don't know if this has been your experience, Dahlia, but I just think the truth is, like, there just can be no mistakes for us when we're going out and financing. It needs to be like really tightly packaged. It just is what it is. There's just no leeway. I've seen packages from other folks that are fundraising, and it blows me away sometimes who gets funding and who doesn't. But I think we just need to like go above and beyond when we go out and fundraise. And not to say that you didn't, because sometimes that's not even enough, but that's been kind of my experience, and I appreciate you sharing that as well.
Well, thank you. Do you have any advice for like me going forward? I was probably interested in maybe looking at crowdfunding. Is that something that might be a good idea?
I think crowdfunding is really best suited to feed the hype machine. So like, crowdfunding is good for marketing and getting hype and awareness around a product. I don't think it's actually the best source for genuinely financing a business, because the amounts are lower, and the process of crowdfunding really just requires a ton of marketing, which is actually an expenditure on the business side. So I'd say, honestly, I think the most powerful way to fundraise is with individuals, angel investors. And you are going to take, I saw you said you had 22 no's. Okay.
Yes.
Yeah, I would say, blanket statement, you should brace yourself for probably 4 or 5 times that, right? Like, I think you probably want to create like a really strong fundraising package, go out and talk to literally hundreds of investors. I think that would be my advice, is to really get comfortable with the fact that a lot of people are going to say no, a lot of people are going to waste your time, a lot of people are just going to ghost you. That's just the way it is. That's the way it is for everybody, myself included. But what you're looking for is honestly like that one person that really believes in what you're doing, and you get that person involved, you get that person to help you shape the fundraising package. Maybe they put $10,000, $25,000 in, you get them to then open doors and help you, right? So I think take that approach, be as iterative as you possibly can. So I think the investor deck, for example, I don't think my investor deck ever stayed the same between meetings. Like, you get feedback from every single investor, you incorporate that feedback, and fundraising is kind of a full-time job, right? So yeah, take that approach. Just like, brace yourself for a lot of rejection, but know that you're looking for essentially one person that really buys what you're selling, and then lean into what they're buying and let them help you move forward. That would be my like really broad advice, not knowing like a ton about your business.
That's great advice. Thank you so much for that. I just have one more question. Is there someone on the Tribe Network team that I could work with in regards to we just signed a 4-year contract with TV, and we are going to be broadcast across maybe 22 different, I guess, stations and channels, Amazon and whatnot. But if we could maybe work exclusively with a member of the team, is that possible?
Hey, Dahlia, I'll chime in. It's great to get connected with you. I know you had applied to the Build program, and so it's great to see you in the workshops. We definitely can connect and see in which ways we can support the organization. And congratulations on your recent news. I had a question, I guess, are you incorporated in Atlantic Canada or somewhere else?
Across Canada, and then we're also global. We went global back in 2022 in fall.
Wow. Okay. Awesome. This is great. I'm really glad we're connected now. I'll send you an email and then we can set some time aside to meet when you're available. I understand you are working full time as well. So.
Oh yes, around the clock. I'm doing 18 hours.
Okay. We'll get connected soon. Thank you so much for these questions. You're definitely operating in a lot of areas. It'd be great to know more about what you do in Karima
Yes,
as well.
we do have 6 divisions, and in another meeting I'll probably get more into that.
Awesome.
Thank you.
Thank you. So just to close off this session, and thank you, Marlon, for your extended time and offering us the insights and value that you have. So we've covered off the questions time, but if you have any additional questions, we'll include Marlon's contact detail in the follow-up email with the recording of the session as well for you to refer back to. But just to close us off, we have a few slides to go through. So there's a new funding opportunity. I'm not sure if everyone has heard about it. It's called the Start Small Grant, and it's for anyone who's racialized that's working on a business initiative, program, project, and wants to get access to some funding. We're having an application process that's open from now until June 6th, I believe, and you can apply at the link in the chat, but we'll also put that in the follow-up email as well. And in this grant process, you'll also get access to mentorship and peer networking opportunities, as well as some programming initiatives too. And as always, we'd love to hear any feedback that you have from tonight's event, what we might improve on, what you enjoyed. We really appreciated the sparseness and sleekness of those slides, Marlon. So I'm sure we'll get some feedback about that too. Really beautiful. It's so easy to like follow the content when it's laid out in a way that is very appealing. So we'll share the feedback with you after too.
Please,
So please fill out the workshop survey when you have a moment. And additionally, there are opportunities, and Dahlia, this might also apply to you and others in the room. If you want to book a grant review session or work with any of our roster of mentors, we have 6 mentors that are available each and every day of the week except for Saturday. So there's always a session available for you, depending on the initiative that you want to work on or the question or challenge that you have. So we hope that you take advantage of the time with any of our mentors. And the additional thing around the Build program, specifically the business supports, is our organizations and residents supports. We have office hours many weekdays. In May, I think we had 6 or 7 sessions planned. The next one coming up is tomorrow with BDC. And following that, we have a workshop session with the one and only Bernadette Hamilton Reed on Wednesday of next week. So we hope that you can all sign up and participate in those to have your questions addressed in a more intimate setting. So register for those as well. We'll put all this in the follow-up email too. This is the last opportunity that we'll share, but we do have burnout and wellness supports that we offer for founders through the support with Blue Nile Wellness and Massage. Fantanish takes us through all the strategies that we need to support ourselves in mitigating burnout as Black founders. And so the next session focuses on yoga. And so we hope that you can all join that. Marlon, if you're available, definitely you're welcome to join that too. I know you're like big in the fitness sphere and space and wellness. So we hope that you can also join. It's a really great opportunity to get connected with folks. I know we see some of the individuals on this call in the sessions too, but overall we just really appreciate all of you attending tonight's session, specifically Marlon for making a topic that hasn't felt very approachable and has definitely been cause for anxiety for a lot of people, making that topic feel really accessible for all of us tonight, and making it feel fun and super involving. So thank you very, very much.
Thanks, Lilia. Thanks, Holly, and thanks to everyone for letting me talk at you for this long. This is really fun.
This was awesome. Thank you very, very much. I hope everyone has a great night. Bernadette, enjoy your grandbaby.
Thank you. I am. She just got out the bath. She smells so nice and fresh. Oh, baby oil and all that beautiful cream.
Love
Thank
that.
you, Marlon. Thanks, everybody. See you some on the
Bye.
22nd. Okay.
Bye, everyone.